Good afternoon. I want you to look at slide number 1, which talks about short-term and long-term interest rates for the United States, 1990 through 1995. And then we'll go on later for additional exposure to short-term versus long-term interest rates so that we get down some basics. Now these interest rates at the present time are much different than what they are listed in slide number 1. This is ancient history, but it's important to know some history so that we get an understanding of money, banking, interest rates, credit, and capital markets. So if you look at the slide, you see that the pink line is the 10-year interest rate on U.S. Treasury notes. That's issued by the United States government. And at that time, starting in 1990, the interest rate was somewhere around 8%. The short-term rate is a 90-day interest rate that I was able to glean from publications. And at that time, they were also at 8%. Interest rates were very high in 1990 because the Federal Reserve was following a relatively tight monetary policy. And that was also in the era of the worried about the first Gulf War. And so interest rates were starting out at 8%. And then as you see, the short-term interest rate fell continuously until 3%. The long-term interest rate took a little longer, but it never fell to 3%. It fell to about 5%. And that differential between long-term interest rates and short-term interest rates will preoccupy us in this exposure to money, banking, credit, and interest rates and capital markets. The short-term rate is important because that's the rate that usually you have to pay or close to that for your automobile loan. And when it's 8%, that would have been a difficult year to buy automobiles because you would have been charged a very high interest rate to buy an automobile over, at that time, 36 months or 48 months. Eventually they changed to 60 months, and now I hear it's even 72 months. But that's the automobile market, and that's the auto industry that extends those terms to you, but they're getting the money from the banks or some equivalent financial institution to lend you the money to buy that automobile. The long-term interest rate, the 10-year, the pink, is critical for determining what you'll pay for your mortgage. 10-year, 15, most likely 30-year interest rate that you have on your mortgage will be closely tied to the long-term interest rate. Now, when I bought my first house many years ago, the long-term interest rate was around 15%. And it was very difficult for many people to afford the interest rate on housing. And so housing sales markets were unusually subdued. And we'll talk about what influences that 10-year rate versus what influences the 3-year, the short-term 90-day rate, the short-term interest rate that you pay for your automobile. But you can notice that the situation in slide 1 doesn't stay the same. There's a differential between the long-term and the short-term interest rate. And that's what the banks like. Banks are in business to make a profit. And what happens, of course, on a regular basis, they have to buy the use of your money or someone else's money, and that is going to be tied to the short-term rate. And so when interest rates are at 8%, the banks do not like that because they have to pay a very high cost of funds, and so their profitability is compromised. As the short-term rate falls and the long-term rate does not fall as much, the banks like that because they can buy the use of the money. And you can see in the chart that when interest rates fell in 1992-93 all the way down to 3%, the bank, if they just wanted to take your money, pay you 3%, they could turn around and invest in the long-term bond market and earn 5%, 6%. And that differential between long-term and short-term interest rates is the basis of banking. They, in a sense, they borrow in the short term and they lend in the long term because it's people like you and me who want to borrow for the long term. And the same thing happens when they lend money to the corporation. A corporation will come to the bank and say, I want to borrow money for a 5-year period, and they'll say, fine, we'll lend it to you for 6%. But we can get it from our depositors and only pay 3%. So that differential between interest rates is critical for the functioning of our banking system. You'll notice in this chart that at the end of 1995, starting in 1995, the two interest rates come together again in a very strange way. You can see that short-term interest rates went from 3% up to 6%. And as that was happening, long-term interest rates for a while were going up back to 8%, so that differential was still providing the banks with some kind of cushion for their profitability. But then you notice something very interesting, that the long-term rate begins to descend and come close to the short-term rate. And it's that movement of long-term rates relative to the movement of short-term rates that will occupy us in later years, because this is what will become increasingly problematic for banks, that the long-term interest rate differential vis-a-vis the short-term interest rate is going to behave very, very differently over time. Now, what's driving that, of course, is that in 1994, the Federal Reserve, which is the central bank of the United States, began to implement a more, what we call, tight monetary policy. They began to, in a sense, reduce the availability of credit. And by reducing the availability of credit, and if there's still a strong demand for credit, that's going to drive up the short-term interest rate. So we usually say that the Federal Reserve, our central bank, and most central banks, have a pretty good handle on controlling the short-term interest rate that influences our decision to buy a car or borrow money for the short term. It obviously influences what credit card companies charge you, but there's more to that. The long-term interest rate, you would think, is also controlled by the Federal Reserve and other central banks. But there's a great debate over that, and we'll talk about that as we go through this course, that the long-term rate is a market rate, and it's influenced by the Federal Reserve, which obviously is important in providing long-term credit. But it's also influenced by the flow of capital from other countries. In other words, other people may decide to invest in our 10-year Treasury bond. And if lots of people come over to the United States to buy our Treasury bond, then it actually increases the demand for those bonds relative to the supply, drives up the price of bonds, and actually drives the long-term interest rate down. That inverse relationship we'll talk about and go into in much detail. But I just want to introduce you to the basics of short-term interest rates, long-term interest rates. The short-term interest rate is less than a year, in this case the 90-day interest rate, and that's heavily influenced by the Federal Reserve, our central bank. The long-term interest rate could be a 5-year interest rate, it could be a 10-year, it could be a 30-year. The one we're looking at is a 10-year interest rate, most common. And that one is more complex, and it is going to be driven to a degree by the amount of capital flowing into our country, namely depositors from other countries come to our shores, and they decide to buy our government bonds as opposed to buying the government bonds of their own country. And one of the biggest flows, of course, is from Japan, where interest rates on long-term bonds has been close to zero for almost 30 years. And the savers in Japan, through their pension funds and banks and insurance companies, decide to move their funds out of Japan into the United States, and that actually increases the demand for our treasury bills, treasury notes, and that will have an effect on the price of bonds, driving them up, and in effect driving those interest rates down. And as you can see in that chart, when interest rates were 8% in 1995, by the end of the year, they had fallen to 6%. The Fed didn't do that. That was being driven by market forces, and so that's where the role of capital markets will come in as we discuss the complexity of our global economy, and the complexities have become increasingly difficult to nail down because the central banks of our country, the Federal Reserve, Central Bank of Europe, which didn't exist at this time, the ECB, European Central Bank, didn't come into existence until they created the euro, which started in 1999 and did not get into full swing until 2001. And the other central bank that's a major player, of course, the Bank of Japan, secondarily the Bank of Switzerland, Bank of England, and the Bank of China, the People's Bank of China, which has, at that time, 1990-95, was a small speck in the international market. But as the years have gone on, over the last 30 years, the People's Bank of China has increasingly played an important role in the capital markets of the world. And it's a role that we don't fully understand because our central bank, the Federal Reserve, has open meetings and there's a fair amount of transparency, not perfect transparency, but the transparency in China leaves a lot to be desired. There's not always a lot of truth, not truth, but clarity and sharing information about what's actually going on in the markets in China. So I can't say any more, so I'm going to end this short lecture and move on to the next slide for the second lecture, and pardon my hand.